Hello everyone, thanks for joining us for our commercial property update. Today we're joined with Adam Murchie from Forza Capital and Justin Mastoris, Principal at Rees Group, and myself, Matt Gibson from Discover Financial Partners. So looking forward to chatting commercial property with you, both of you today. Before we start, just a quick disclaimer. Everything we cover today is general advice and not to be considered as personal advice, but feel free to reach out if you do want to seek advice on anything we've discussed today. So to kick it off, so Adam Murchie is the founder of Forza Capital, and Forza's completed over $500 million of commercial transactions to date. And so we're looking forward to getting his view on the market. But before we do that, Adam, I thought it'd be good just to start and wind the clock back a bit and find out a bit about what got you into the commercial property space and then leading on to founding Forza.
Sure. So purely by accident. So my background is I actually studied sports commerce at Deakin and started life running as the CEO of the State Cycling Federation in Victoria. So ran that for 4 years. And then after what was an interesting journey there, rebuilding a sporting association that was pretty much broken at the time, had the opportunity to go across and work for a private property group. So started there in 2001, met my business partner today, Ashley, at that organisation. So we've worked together now for 20 odd years, and we literally built a property funds management business from the ground up there, which then became a precursor to setting up Forza in 2010. So we didn't leave and set up Forza because we had some form of implosion during the GFC. It was just a fragmentation of the management of where we were, and Ash and I, given we worked as a team for so long, had a number of clients ask if we were going out under our own steam. We saw the opportunity to do so. So literally bootstrapped our own business. So we are the owners. We haven't had any third-party equity come in and seed us as an enterprise. And so we just started literally off the smell of an oily rag, but with a view that at that point, financial services was broken, or in terms of the nature of how it worked, with a lot of conflicted fees and the models around vertical integration. We believed that fee for service was the way forward. At that point, the whole retail investor universe had been completely scorched by the GFC. So we focused on high net worth investors or wholesale investors, which was the core of our client base anyway, and literally just worked on the basis that each deal had to stand up on its own merits. We had a view as to how each asset would be constructed and managed. And a lot of that was just born from our direct experiences in what we saw that worked and didn't. We just had a very strong conviction view of what we sought to achieve as a business. And it's funny, we dusted off our plan from 2010 as part of our planning day early this year, and there's not an item in it that I would change. So would love to say I'm Nostradamus and our crystal ball worked, but it was just a view that we had strong conviction in a number of things that we saw that we felt were going to change, and backed ourselves on that. And here we are 11 years later.
Yeah, it's a great success. And I guess it's the thing is, when you start in tumultuous times, it probably gives you the right mindset when it comes to how you approach deals moving into the future. And I think you've carried that conservatism through to your benefit the whole way through. Certainly
I say to people, Matt, don't worry about where you make money. Worry about where you don't lose it first. So always try and insulate or insure you against your capital piece in any transaction before you worry about where the upside is. I think that's a bit of an art form, and I think that's something that we spend a lot of time concerning ourselves with. And Ash in particular has got a pretty well attuned nose for risk and where property deals in particular fall apart. And I suppose on the counterpoint to that, from a structural and operational point of view, in terms of our funds, I spend my time looking at where the risks and the areas are there that we need to improve and better hedge against, and hopefully we just build an overall better mousetrap as a result.
Yeah, fantastic. Oh, thanks for sharing that with us. So There's some big questions in the commercial space we're hoping you can answer for us today. I'll throw it over to Justin. He can fire the first one.
Well, first up, welcome everyone. And Adam, I think it was September last year. We were in lockdown in Melbourne, and we thought we'd brief everybody and give them a rundown of where we thought things were heading from a property point of view. I think you may have had a chance to have a look at what we said back then. Any comments about maybe some of the direction we thought things were going in and where the commercial markets ended up at the moment?
I did have a look, Justin. The good news is, like all economists, I'd say I was about 50% right and 50% wrong. So a nice, happy, middle ground result. So the bits I think we were right on were the nature of office, and which we'll probably touch on again today. The nature of office itself was really interesting, and that it wasn't dead, and that there were some really interesting things happening in the evolution of office. I think that's actually playing out to be the case. And we're seeing some real interesting divergence at the present time between what's being reported in the headlines and what we're seeing on the ground. The bits I got wrong, but I'd like to say so to everyone, was the absolute and utter dysfunction we thought COVID would throw up from a market or a cycle point of view clearly didn't materialise. In fact, the government pulled victory out of the jaws of defeat, I would suggest, and did a fantastic job in stimulating, or I'd say, given market conditions now, possibly overstimulating the market. But we've gone from one where we were thinking that there'd be some very exciting and certainly interesting opportunities coming about as a result of some dysfunction, distress. We've got the complete inverse of that. So on that one, I was fundamentally wrong.
Yeah, and you think that was stimulus, and that's why things are so buoyant?
Yeah, I mean, there's a number of parts to it, but largely, yes. I mean, look, interest rates are low, and short-term, or certainly on 3-year money, the RBA is intervening to keeping those rates artificially low. If you look at rates at the moment outside of a 3-year duration, so 4 and 5 years plus, it's a very steep yield curve. So that's the first thing, that interest rates being really low has given people firepower, and then savings have been as high as they've ever been. So during the midst of last year, savings rates got north of 20%, which is almost unprecedented. And even now people have gone and they're spending the money again, hence what we're seeing across markets and asset prices. It's still at about 12%, which is still historically a very high level. So we have a view that these dynamics will probably prevail for a little while yet, unless something else happens that upsets the apple cart, so to speak. But low interest rates being held low near term by the RBA, and still historically high levels of savings, cash looking expensive, and no real obvious opportunity set to invest in. We sort of think property will be like a lot of other areas at the moment, and will probably continue to be sought after and bid up quite heavily.
Just on the inflation and the yield curve observations, Adam, do you think, so if we do see a bit of surprise inflation in Australia, do you think that the commercial market, with the sort of supply and demand imbalances that exist, do you think that the market's positioned well to withstand any sort of surprise uptick in rates? I know certainly we look at the share market, it's very nervous and skittish with inflation numbers, as it rightly should be at the moment. But what's that look like from a commercial investor standpoint?
Yeah, fair question, Matt. I mean, if you take, you mentioned about sort of equities or the listed market, the A-REIT markets have a listed property market. Every time there's the spectre of inflation, it gets hammered as well. So, which I suppose is the market's view, or a precursor to what happens to pricing. I mean, it's an interesting one because there's a short-term and a long-term piece to that response. The short-term answer is pricing gets hit typically because two things happen. Firstly, your interest cost increases in terms of servicing any debt you're carrying, if you're carrying debt. And secondly, what then typically occurs as a response is that the cap rates for property, or the price earning yield that property trades at, softens near term. Now, long term, generally property or real assets benefit well from an inflation environment because with time you end up with higher rents. and therefore that drives higher value. But short term, you can end up with a little bit of a pinch point or a squeeze, if you like. That's something that we're mindful of. Something a quite close friend of mine suggested at the back end of last year. He's a fixed interest manager, quite a high profile one as well, and was saying, he was asking me over a coffee, how many of your leases are CPI linked? And I said, okay, that's an intriguing question. Why do you ask? And he said, well, I'm looking down the line and seeing that there's some inflationary impacts potentially starting to play their hand here. CPI linked increases might be something worth investigating. And that's something that we've been looking at for circa 6 months now in terms of renegotiating leases and or new acquisitions, whether those leases we should be looking at CPI indexation. Now, it depends on what the level of fixed increases are at the moment, but that's an interesting question, because if you bought a long lease expiry type asset on fixed increases and there's a bit of an inflation spike, you could actually have a disinflationary impact on your cash flows relative to what it would be if you had CPI indexation or a shorter lease expiry, because you could capture that upside at the tail end of the initial lease term. So we're looking at that quite closely, because it has impact in property across a number of fronts. You know, value of future rental streams, existing lease construction. So it's a pretty important thing to basically for us to be aware of and to understand how we can use it both to manage risk but also potentially drive the future value of our investments.
Yeah, great solution. And hopefully it may trigger some attractive deal flow as well, if some people are tapping out in the event of inflation shocks.
Well, market's pretty finely balanced at the moment. I mean, a good way of looking at it is to always understand the risk premium for property over the risk-free rate. So the risk-free rate being 10-year bond yield, and the differential between the property yield and the bond yield being the premium attached to property. So historically, that's been circa 300 to 400 basis points, or 3 to 4%. So I think the current 10-year bond yield at the moment is about it's oscillating a little bit, but say somewhere in a band of 1.6 to 1.8. So that's saying yields of sort of high 4s to 5. Now, industrial is getting close to low to mid 4s. Commercial office is probably mid of the range at the moment, but what's happening is that risk premium is compressing. And that basically what's happening is that squeezing the profit margin or the risk margin in these deals. And that only goes on for so long. I think it's probably chased the yield curve down as far as it can go, and now it's a case of who's prepared to take the least. In the pre-GFC, that risk-free rate effectively went to zero or below zero, because the property yields were trading less than the cost of interest rate. That was a function of some crazy gearing levels and rampant rental growth at that point in time. So we certainly don't have that dynamic at the moment, but we certainly don't have the rampant rental growth either. So we're watching that closely. At the moment, we still think there's a reasonable margin of safety in there, but the further that tightens, the sort of more interesting the tipping point or the balance point becomes.
Mm.
Interesting. Adam, shall we maybe break it down and talk about, you mentioned offices before, so if we just sort of look at some different sectors, I'm sure everyone will be keen to hear offices at the moment, around where we are in inner city Richmond. It's probably a little bit different to some parts, but maybe CBDs, if we talk about CBD cities around Australia first.
Oh, it's not dead. It's far from it. In fact, what you see in the press, in our view, is very different to what's on the ground. And I'm not talking just Melbourne. I was in Sydney for 2 days last week. I was in Brisbane for a couple of days earlier in the year, back in March. And their CBDs weren't, in my view, from what I can recall, pre-COVID, very different. In fact, my litmus test for going in Sydney was to go to the food court in Australia Square, which is on George Street, which is typically humming, and it was absolutely heaving. So, yeah, there might be a reticence from people to return to the office, but I mean, this is the nirvana circumstance for any employee that doesn't want to go to work. I don't think there's ever been a better time to get fully paid without actually having to do what you need to do. And I think that with time is starting to erode a little. Speak to the business owners, speak to CFOs, they're a bit frustrated at the moment. In fact, one catch up last week, I asked how often they were at the office, and the answer was 1 day a week, and we rotate teams the other couple of days, and no one's at the office on a Friday. And I said, are they working on a Friday? And there was a wry smile and said, you tell me, what do you think? So, and my next response was, well, okay, when do you get back to the office? And he said, well, that's the thing. At the moment, everyone's, there's a war for talent. Everyone's fighting to keep their staff, and it's a little bit of a case of who blinks first. Who's the first to say, right, we're back to the office? Another interesting bit of anecdotal evidence I had from quite a large business was up to about 60 to 65% occupancy of the Melbourne headquarters. So if you think before that last lockdown we had, they said it was sort of flighty. You could have anywhere between 30% of the headcount and 60-odd% of the headcount on any given day. The minute it got over that sort of 60 to 65% mark, he said within the next 7 to 14 days, they were at 100% occupancy, because the fear of missing out overwhelmed the fear of being at the office. So for me, that's where the more interesting data set arises, because it's one driven by human behaviour, and it's not driven by logic or sort of market fundamentals. So we talk about people being reticent about catching public transport to work. Well, have a look at them catch the train to the MCG for a football match. Go to a bar or a pub or a restaurant on a Friday or a Saturday night at the moment, they're absolutely heaving. So there's a bit of a differential, if you like, which is sort of circumstantial between whether it's on your private behaviour or a private account, or whether you're at work or trying to avoid work, as the case might be. So what we think is happening is it's accelerated the flexibility of working from home. I think a lot of businesses, with the advent of cloud-based computing, are able to have people work more remotely more often now. The question is one of structure. How many days are at the office and how many days are allowed out of the office? And it seems to be settling at sort of circa 3 to 4 days in the office if people have their way. But the question, if that is the case, is, well, if you want 100% of your team at the office for 3 days a week, how do you fundamentally reduce your footprint? So that for us is where it's interesting at one level. The second part to that is the actual nature of the workspace construction is changing. So I mentioned in the webinar last year that I suppose the 2 decades of workspace compression, and what we mean by that is the amount of square meterage per employee was starting to shift. That has actually accelerated off the back of this. So we've been regularly speaking to architects and fit-out consultants about both what they're getting in terms of demand down the pipeline, because that's the precursor to office leasing. The first thing you do is look at what's available. The second thing you do is speak to an architect about designing your space. And then the third group you speak to is a fit-out consultant about building it. So we're speaking to those groups to understand what I suppose the future demand looks like. And they're saying that the demand is actually quite strong at the moment, but that there's no doubt that the workspace ratio per employee is definitely changing. Part of that is more breakout or more flexible space, media rooms. I mean, we're doing this remotely, the three of us. If you're in an office setting, you could not do this in an open plan environment. So you're starting to see more sort of, I suppose, video conferencing or breakout areas. And again, this war for talent and giving people a reason to come to the office, more sort of social space within the office footprint. So our view is the office isn't dead. It's just that its construction is evolving.
So basically less economy seats and more up in business class and first class.
Isn't that the way everyone likes to fly now?
Exactly. Well,
yeah, it's interesting, but we're really fascinated at the moment by just the feedback on the ground. Even leasing activity is increasing. I'll give you some stats here. So excuse me while I read some notes, but I think getting into some granular detail is pretty important here. So this is just one agency that we were speaking to, but which is Colliers. So in that agency, they've done 162 deals over the first quarter of 2021. So this is leasing transactions. So of these, 84 were within the CBD and 78 non-CBD. There were only 11 deals over 5,200 square metres attributed to occupiers decentralising from a CBD to a non-CBD location. But that was then offset by 12 leases of almost 4,500 square metres going from the non-CBD into the CBD. So your net effect has actually been zero. And they're saying that they've had their, the biggest first quarter of leasing inquiry in 20 years. Now, bear in mind, that's a bit of a distorted statistic because part of that has obviously been dragged from last year into the first quarter of this year. But notwithstanding, it wasn't their worst quarter in 20 years either. So we're looking at this and saying it's a fascinating construct in terms of what we're reading about on one hand in the press and what we're seeing on the ground on the other hand. And that's actually what we love. So our view at the moment is trying to understand this and see where we can actually take advantage of this dysfunction or misinformation is actually for us the opportunity set. So what are we looking at the moment? We're trying to buy mispriced office that has some leasing risk that we think it's overstated. We think in 6 to 12 months' time, the dynamics or certainly the discussion around office will be vastly different.
And I guess historically, if we look at the assets that you've bought in Forza, you've had a very good record at being able to get tenancies reconfigured and maximised on the assets that you've bought. So, I mean, that sounds to me like a good play to your strengths.
Yeah, I mean, we're not Robinson Crusoe on that either. There are other groups that do that well. But, I mean, I suppose we understand what we're good at and where we work well, and we just try and play to those strengths. And we understand office and tenancy requirements in particular. We understand, particularly these dynamics, that the tenant is the kingmaker. So if you can find assets that have got the right attributes and you're able to marry that up with tenant interest, I should say, and you can move quickly, that really is the bit that changes the game in terms of being able to manage the risk profile and then create some value out of these sort of disconnections, if you like, within the marketplace.
Maybe we should, we'll jump onto another asset class. I know you briefly touched on industrial before. I know just in my dealings with clients and their property holdings in that space, been seeing some absolutely astounding numbers around the sort of growth rates that have been achieved over the last handful of years. And you mentioned before the risk premium in that area is really narrowed, and the yield you're getting is really quite small by historic standards compared to the cash rate. What's your feel on that space? Is it a sort of do not touch at the moment, or could there still be opportunity in that area?
I actually do think, despite the pricing at the moment, that there is still opportunity out there. It's just quite hard to find because you can't just keep bidding to win an asset and be agnostic as to its risk profile. But we do think that there are interesting little sections within most of the actual property markets at the moment, which I know sort of flies in the face of, I'm typically a little bit sort of contrarian and pessimistic when it gets to these points in a cycle, but there are some interesting little, I suppose, sort of segues and disconnects that COVID has created. So industrial, I mean, of all the sectors in property, it has had out and out performance since the GFC. I mean, to give you some context, Blackstone's just sold a $3.5 billion industrial portfolio, purely Australian based, on an average cap rate of about 4. Now, if you rewind to post GFC, industrial was trading somewhere around a 9 to 10% cap rate. So in terms of what it has done over the last 10 to 11 years is nothing short of astounding. Rightfully so in a lot of cases, because that performance tracks some secular shifts in the way goods and services are delivered across the globe, not just here in Australia. But some of it potentially is a little overstated. I won't say who it was, but someone quite high profile we were having this chat with recently. I asked on their views on industrial, and they said, well, it's really interesting because whilst we're all talking about the rise and rise of logistics, he says that it's not like there's a new market that's been created. There's been some massive shift in the way goods are produced. He says, all that we have done is shift where goods are stored. So he says, in a lot of cases, some of these goods used to be stored in the backs of existing retail centres before they went onto the floor. This is whereas now they're more using a bit of a just-in-time type approach to this stuff, or they're shutting down the main retail footprint and going online. So their argument was, I don't know that we're necessarily or fundamentally creating any more goods. It's just a case of we're shipping them differently and transacting them differently. So is what we're looking at not the creation of a new market, just a shift of an existing profile, which to me was actually a really interesting comment when we sort of went and picked that a little further with them. So we're sort of mindful of that. Where are the real winners and losers in this space? The other thing to bear in mind too is that some of these assets are huge in size, quite often have single tenants, and quite often have some quite specific improvements. So the question becomes, particularly now where there's a lot of acquisition of assets with extremely long lease expiries, they're being traded on absolutely tight prices. That's because people are buying the security of the cash flow, but the question becomes, what's that asset worth without that tenant? Or what money do you have to throw at that tenant in order to retain them at the end of their lease? Question will be in time will be, did they actually represent good buying? I think in some cases the answer is no. We quite like sort of the older style multi-tenanted assets in the suburbs because they've got great repositioning potential. They just perfectly fit this last mile distribution dynamic. But again, they're being fairly keenly sought after. So it's just where the entry point sits. We still truly believe in industrial as being a fundamental part of the Australian property landscape. Just it's the balancing point is just finding the sweet spot between the risk and reward profile. We are looking, but of all the markets, it's probably the hardest to find value in right at the moment.
Should we talk about just yield? That's interesting. Inner city yield on not necessarily offices, but whether they were leased spaces. There's one just opposite our office in Richmond that Matt and I were at the auction a few years ago, and if we look at the smaller end of the scale, the mum and dad super fund was buying the office across the road, single tenant, and it's probably been vacant, Matt, for about 8 or 9 months. Yeah. Are we seeing many of those sort of spaces around? And I suppose, what are you guys seeing?
Yeah, there are examples of that. I think the obvious one at the moment is retail. I mean, there's a lot of retail vacancy at the moment, certainly here in the CBD. And it was interesting comparing Melbourne to Sydney last week. Sydney just does not have in their CBD the same level of retail vacancy we do here, and I think that's just a function of the extent of the lockdown we've had here in Melbourne. We are hearing that the retail leasing inquiry is starting to pick up a little bit, but I think they'll probably be wanting to see more sustained CBD foot traffic, or certainly a deeper return back to the office before that sort of gap closes. But to your point about office, Justin, I think that example you use there is probably not the ordinary circumstance or the ordinary outcome. That to me sounds like someone that's hanging out for a circumstance that's changed. I mean, just because you own the asset doesn't mean the tenants will occupy it. Net effective rents near term in office have fallen because you've had to compete more readily for tenants and offer them a greater incentive. That sounds a case of a vendor or an owner that doesn't want to offer the market what the market needs, and therefore they'll just eat the vacancy for the near or the foreseeable future. So we're finding those that have been pretty deft with the footwork and responding to the market dynamics are doing fairly strong leasing deals. I mean, there is, as per my stats before, that it's not the leasing deal's not there. It's just that tenants are recognising it's a competitive landscape, so they're going out and negotiating the best deal that they can and negotiating as hard as they can, as are the tenant reps in some cases that are looking after them. So there'll be winners and losers out of that dynamic, but that happens, I would say that happens at any given point in any given cycle. Those people that either miss the market or aren't prepared to accept the current market terms will just sit on the sidelines. And in some cases, if they've bought the asset well enough and they're not under pressure to do so, they're often quite happy just leaving it vacant.
Yeah.
Fantastic. Well, thanks, Adam, for for giving us around the grounds and some great insights. I guess from what you're saying, there are opportunities out there, which is reassuring. And even though there are risks, there are ways to manage that if we're savvy with our investing. I guess just any parting thoughts from you, Adam, and is there any deals that are on your radar at the moment that you were allowed to talk about?
No, look, to be honest, there's nothing on the radar right now that I can share. On any given day, I can tell you we're looking at something, and then 9 times out of 10, that has done a Houdini and disappeared into a puff of smoke. So there are a few things we're canvassing at the moment, but nothing quite there. I mean, at this point in the cycle, I think it's just opening your horizons or expanding the horizons a little bit. And I say to the staff here, first couple of things, don't accept what the sort of the community, the marketplace is telling you. Quite often it's wrong. I mean, active managers or hedge fund managers work on the basis of imperfect information. I think there's plenty of it around at the moment, particularly as everyone's trying to scratch the surface to find out what's going on underneath and determine the way forward. So I think there's a lot of misinformation or imperfect information, and therefore you need to be very curious at the moment and be sort of consistently trying to expand your universe or your thinking to find the changes that will influence or impact an opportunity, and also where the next round of wealth creation comes from. The second bit to it is don't necessarily be worried about some of the negative headlines. I mean, the two areas we're sort of really canvassing at the moment are office and retail. Now, they're the two markets that would seemingly be the most on the nose. We like them because we're not convinced that they're as broken in a lot of cases as the market suggests. Some parts are fundamentally impaired, and they are for a very good reason, because they're probably old world style assets that haven't quite transitioned to newer market dynamics or opportunities. But there are plenty that do sit in they've got the new market dynamic, but they've just been tarnished with the same brush. And therefore, if you can take on some of that leasing risk, or in the case of retail, it might be that the actual retail footprint's a relatively small proportion of the overall land mass that it sits on. So part of the site has redevelopment or repositioning opportunities or additional value add opportunities. And we think that's fantastic. One of the most interesting things I've seen in repositioning retail is that they're converting some of these things to car showrooms and car servicing centres. I think that's just an absolute standout way to deal with these kinds of things. Bring the services to where the people are. And I think you're going to see more and more of that, where non-traditional retail users go into what would be deemed a traditional retail asset. So we think that's one. Don't necessarily hold the view that what it was is what it will be into the future. And I think that rings true for both office and retail. So we're looking at those assets classes in particular, given that they're quite dysfunctional in terms of pricing and the cycle. There's obviously a lot of demand around healthcare, childcare, and these kinds of assets. We understand that. They're being bid for pretty highly though, so they're quite price sensitive. We're sort of stepping out of that, looking at those areas at the moment. So for us, we're sort of sticking to our core of commercial office, industrial land bank style deals, and an interesting retail play, if that makes sense. Obviously, the other major dynamic here has been the rise of private property debt. I think near term that's here to stay while the banks have retreated from part of it. It's not as risk-free as it sounds. I think I would say that the returns being promoted today, the 10s and 12s today have a fundamentally higher risk profile than the 10 to 12% that people were getting 18 months to 2 years ago. So I just sort of caution and say go in with the eyes wide open. But at the moment, I think the market dynamic will continue to roll for a little bit. Does sort of take my breath away slightly, but I recognise that that's just where we sit. Interest rates are cheap. There is still a lot of cash sitting on the sidelines, and there are a lot of people getting frustrated about doing nothing. We know what happens. It just continues to see a little bit of price escalation. So with that, we continue to just beaver away in the background, and at some point, we know something interesting will pop up. It always does. We're just not quite sure when and how.
Well, we look forward to when that next deal drops. So, Adam, thanks for joining us. You're always very generous with your time and fantastic insights. So thank you very much.
Thanks, Adam.
Thanks, guys. Good to speak to you both.